I see you rocking back and forth there. You
I
did the
am.
music, huh?
The intro music is pretty stellar.
It gets you ready to go, doesn't it?
I'm ready. That was fabulous, actually.
How you doing, Tim?
I'm good, Greg. Thank you for having me today. It's a real privilege and honor. So
Well, I appreciate that. Looking forward to this conversation. I know you're at the NYSE right now, and ICE owns that building.
Yes,
must be pretty nice. I guess you have some pretty good access there.
Well, I mean, it's for me, it's humbling a little bit. When I came in this morning, knowing we were going to do the podcast, I wanted to do it at the New York Stock Exchange. Every time I walk in, I'm like, why is Tim Bowler walking into the New York Stock Exchange? Brings me back to a teenager or when I was in college studying business. The idea of going to the New York Stock Exchange was just like, it was something you would dream about, and then to be able to actually work in the building, to be able to go down to the floor, to be able to host people to the floor is it's pretty special, and it's a pretty unique opportunity. So.
Well, you've had
it's the heart of American capitalism here.
It is. Yeah, you've had a remarkable career, and you're very much in your prime. You've been in the private sector. You've been in the public sector, back to the private sector.
Yes.
You went to William and Mary in Virginia, and you live in, you
Good
go between Jacksonville and Brooklyn, right?
Yeah, well, actually, I split my time working-wise really in a multitude of places. So our business is really, has two primary locations here at ICE Mortgage Technology. So one out in Pleasanton, California, where the old Ellie Mae was headquartered, and then one in Jacksonville, Florida, where the old Black Knight organization was headquartered. And as you know, Greg, we have two core systems of record that really support the mortgage origination industry and servicing industry. Encompass on the origination side and MSB on the servicing side. But we also have offices, throughout the country. So we have a business called Simplifile, which records some security interests at the county level. That's out in Provo, and I try to get out to Provo a few times a year. ICE itself is headquartered in Atlanta, Georgia. So I'm down seeing headquarters at least on a monthly basis.
Your frequent flyer miles must look very pretty.
They're substantial, but they go to my mother because when I'm
got to take care of mom, Tim. That's good. Look, hey, look, everybody loves you already. Just hearing that line. Let's just end the interview. It's over.
Though, but it's a little selfish on my standpoint because when my wife asked me like, what do I want to do for vacation? I'm like, just can we drive somewhere, baby?
So I don't want to be on another plane. So all right, let's jump into business here. So MERS, Black Knight, Ellie Mae, Simplifile.
Yes.
You're doing a lot of acquiring. And I know that you are hyper-focused on an end-to-end solution. Are you through acquiring, or are you just getting started?
On acquiring, obviously not a near-term focus for us right now. I think our big focus in the near term is really doing, for what I keep saying, 4 core things. First and foremost, just relentlessly trying to improve all the underlying, products, services, solutions that our existing client base uses today. That's kind of like my first eye. The second, and there's going to be just a ton of work on this over the course of the coming weeks, months, and quarters, Greg, is really integrate, the underlying, systems of record we have, the data sets that we have, the solution sets that we have, such that our client base, and the mortgage ecosystem can really truly have a life of loan digital experience from that point of origination all the way through. I think the best day in any homeowner's life is when they make that last payment on a mortgage. So that can ride much more efficiently on a unified digital rail for that entire life cycle of a loan. And then the third thing we're focused on here, at least in my job, is innovation. Because you got to relentlessly be innovating in this job, and particularly in the environment that we're in, we're always have to figure out how we can innovate better so our lenders can meet their customers in a much more efficient manner. And then how we can also just help make the system more efficient and wring cost out of it. So those are my 3 core I's that I stressed with my team. And then I always end with one P, which is that's the partnership that we got to show to, our existing client base and prospective new clients, how we can partner with them better to deliver across those 3 I's of improving, integrating, and innovating.
So I don't hear an M. You know what the M stands for?
No, I don't.
It's like a bad word. Monopoly.
Okay.
Uh, some people look at ICE and they, look at ICE, look at FICO, look at other entities, and
Hmm.
look at it through a skeptical lens, and there's fear, right?
Okay.
The industry's been through a lot, and you guys control a lot. I mean,
Hmm.
you've got, I think, 60+% of all the LOSs, people that log into the origination system, and I know that's not what you're trying to do. Um,
Hmm.
so I want you to speak to that. I want you to speak to, what it's like to be on top of the mountain and to have people taking various shots and putting you in a less favorable light that doesn't match your mission.
Well, I'll tell you what it's like from my perspective here, which is the competition is fierce. Every client engagement I have, somebody's either trying to take business away, try to convince them to move to an alternative solution set than we offer. And then, when I'm out talking to folks that aren't using any of our core technology or solution set, it is hyper competitive. So from my perspective, there's plenty of existing competitors. There's a whole bunch of new startups that are coming on play that are competing with us that I hadn't heard of years ago. And the feedback that we continue to get from our clients is that you got to deliver across those three eyes, Tim, or the positions that you have in the market today, don't count on them lasting forever. And that's a message I always bring home to my colleagues that don't be comfortable, don't rest on your laurels. Sure, a large percentage of the loans that originate in the United States flow through that Encompass ecosystem, but that wasn't always the case, and that doesn't have to be the case and it won't be the case unless we deliver across those three eyes of improving, integrating, and innovating.
Yeah. So one of the reasons I wanted to have you on, and I love that answer. Thank you. Is just I won't call it misperception, but you've got a lot to offer, a lot to say, and I know you're
Mhm.
trying to do some great things in the industry. So bringing you and making you more visible to our community, I think, will help to clear up the normal misnomers. Another one of them is that you're not open to other entities plugging into your system. I know that's not the case. That you guys, my understanding is that you're constantly bringing on third parties, and you don't close that out.
Well, I mean, actually, that's one of the core strengths of our ecosystem. So now, if you just take a step back for a second and think
Yeah.
about like Encompass, which is the market leading loan origination system.
Yep.
What are the things that the legacy Ellie Mae did better than most organizations I've ever come across? Was actually operating an open network, that allowed folks to dock in, allowed clients to have choices around like what type of tools that they wanted to leverage within the context of how they were engaging with their customers, how they were processing a loan, how they were fulfilling a loan. And it was, I think, that open network that really benefited Ellie Mae relative to a lot of their competitors, prior to ICE acquiring Ellie Mae, almost 4 years ago now, 5 years ago now. And so from our perspective at Intercontinental Exchange, we are just 100% committed to maintaining that open network, letting innovation flourish in our in our ecosystem, while at the same point in time, just being hyper aware of the responsibilities that we have of maintaining those core systems of record, whether it be on the origination side with Encompass, or on the originations or on the servicing side with MSP.
All
So
right,
it's
two other quick sensitive areas, and then we'll jump into some other fun stuff. Um, Latency of the system.
yes,
Are you constantly tackling that? Some people feel like the system is just too slow. I imagine that's like the voice you hear in your head.
every
Um,
night,
you know,
every night, and
what are you
this.
doing? What are you doing to address that? Is it a real thing? And if so, how do you approach that?
Well, so I think it's a couple of things. Number one, you do have to take a step back for a second and understand that, like with Encompass, it is the system of record, and how every client uses that system of record, can vary. And so, the folks, will use it for all different types of purposes, and then we'll have some potential impact associated with their latency. And you have to understand each use case, very specifically to be able to give feedback. However, and this is, super, super important, there's two macro points that I would, on this, that I want to stress to your listeners around just latency issues, particularly with Encompass. Number one, over the last, 7 quarters since I've been in my seat, I've been working extensively with our engineering team just to figure out like how every release cycle, every couple months, that we can find ways just to help improve the macro client interface with Encompass, so it'll be faster. And some of that's on our end, and actually a lot of it's us just engaging with our client base to see how they're engaging with the system of record. When they're engaging with the system of record, what do they have on their system of record? Secondly, and this is important, this is something that we've gone back and forth with. Also, just thinking around like how do we evolve to a much more modern architecture with Encompass that's more API driven relative to SDK driven. Because if you look at what causes a lot of latency issues in Encompass, it is actually some of the legacy SDK work that's been done, because it's firing at the same point in time you're firing your usage of your system of record, and that creates latency issues. And I think that was one of the bigger drivers for us, actually, to try to work in partnership around the SDK transition with the industry over the course of the coming quarters, and just for that matter, Greg, over the course of the coming years. So issue we want to tackle head on.
Yeah, you and I talked about this because you I say you because you may not have written it, but obviously all roads through ICE Mortgage Technology lead to you. But when you made the announcement that you'd be sunsetting the SDK, people were like, whoa, where did this come from? And then, of course, the armchair quarterback started chiming in. I was one of them. I'm guilty. But I was so impressed with the leadership that you showed. You knew that maybe it could have been it could have been rolled out better, and the communication could have been better. So you immediately listened to your clients and turned the thing around. That was incredible. That's when I started to fall for you, just so you know.
I always fell for you, Greg. So like,
well, you know what? Who could blame you?
Nobody. But actually, that's at the end of the day, no organization and no human being is perfect, as you know.
Sure.
What drove our push to try to sunset the SDK was very much the fact that there's a better way of doing business. There's a better way of interfacing with the system of record that was going to drive massive latency benefits and massive efficiencies at our client base. And you got to put something out there. You got to put a marker out there, in order to actually get an industry or a subset of an industry to start moving. And we did that over the summer of 2024. But you also got to listen to people, and you got to listen to your client base. And the feedback that came back was absolutely we are in fierce agreement with transitioning from an SDK based architecture to an API first architecture, but we just need some more time. And that made it easy for me, as the executive here, to basically say, okay, we've listened. Here's what we're going to do. Here's how we're going to do it in partnership. And we're going to make certain that we're working with you, hand in glove, to be able to help you have a better experience with Encompass.
Yeah. Well, I appreciated that. So I want to jump into,
and by the way, for you personally and for your viewers, we're a feedback first culture here. So like, it's super helpful to get feedback from everybody across the industry as to how we can actually be better partners.
All right, so I'm going to put you on the spot then,
sure.
since you said that. I mean, other than the latency issues, can you think of one or two other things that you hear often, and what you're doing to address those?
Do more for us, I think, is the number one thing that I continue to hear from from our existing client base on the origination side and on the servicing side. So it's, can you offer more solutions? Can you find ways to potentially help us be more efficient? So, and then I'll give you, a couple examples of that. Number one, so, we've had a product and pricing engine here at ICE, or the old LA, then we call it EPPS. And we got a lot of feedback from our clients saying, you haven't invested in that in years. Can you fully modernize that, re-equip it? So maybe, I have an alternative that docks natively into Encompass for my product and pricing services. We listen. We're in the process of doing that. Over the course of, calendar year 2025, I think our existing client base that uses that service, I think is going to have a fundamentally different a different experience with what they're doing with the product and pricing engine relative to what they've experienced today. On the servicing side of the business, we get tons of inquiries like, how can we be more efficient, as a servicer? And how do we be able to interface with our customers in a way that makes it feel high touch and that they feel valued, while at the same point in time being a more efficient organization. And we're spending an awful lot of time in that regard. The best example being just using technology to help better understand why somebody might be calling into a servicing center, such that that customer service rep can be prepared to go help them. And as better than probably anybody within the context of where we are in the industry, and also just what's going on, in the taxes and the insurance markets, it really is a lot of that having to do with escrow and really understanding why somebody's calling in within the context of things changing their escrow account, because insurance has changed dramatically because of the geography that they live in, or taxes are changing dramatically because of the fiscal situation in many of the states and localities people are living in. So it's, those are two good examples that I would give you that where we're investing to try to just enhance some of the core services that we have today.
Man, your team's not going to be happy with me. We talked about some subjects, some amazement. Well, because I have so many great things to talk to you about, and you keep taking me down these roads. You just mentioned insurance.
Yeah,
I know that in your time,
but it's important. Like it's driving large increases in people's monthly payments.
Let's talk about it in this context. So you previously served as the U.S. At the U.S. Treasury. You were counselor to then Treasury Secretary Jack Lew, as well as acting assistant secretary for financial stability. And Deputy Assistant Secretary for the Office of Capital Markets. I mean, among the things that you worked on was HARP and TARP.
Yes.
So you've got, talk about an expert lens.
Yep.
Let's talk about a couple of things having to do with the mortgage business right now. Let's get off of ice just for a few minutes here and start by talking about insurance. I mean, how concerned are you about it? Are we reaching crisis levels? And if so, any suggestions as someone that helped to architect some things that you could argue saved our economy during the lowest of low times?
Yeah.
What do you see?
I'll answer that question like, are we in a crisis first? It sure feels like you're a crisis if you're in certain geographies where there's obviously an insurance vacuum where you've seen your rates just skyrocket, and there's obviously then knock-on impacts across the entire ecosystem because the way insurance operates, it's a mutualization obviously of risk. So even though you might live in a relatively safe geography, if alternative geographies are having large events occur, whether it be fires, whether it be hurricanes, storms, flooding, the entire ecosystem obviously it's going to bear some cost of that given the mutualization nature of insurance. So it has me deeply concerned, clearly in specific geographies, and then also on a macro basis that the social, the mutualization of that risk, if you will just make insurance much more expensive, even in geographies that might be necessarily safer. So then, what's the solution to that? And I wish I had one like I could just say, oh, that's easy, just do A, B, C.
Well, I could tell you one that's been bannered about. Is it bannered about?
Yeah,
bannered about.
Bannered, of course.
Bantered about. Yeah. Okay. That is having. This is popular for some, unpopular for others. Have the government have a backstop for insurance. Sort of like FEMA and flood zones.
Yep.
Have the government get involved in some manner. I mean, first of all, are you pro or against that idea?
I don't know because I haven't. That's not where I.
Well, not that idea in particular, but in terms of the government coming to the rescue when needed. I mean, you were at Goldman Sachs during the financial crisis. The government. Is it safe to say the government saved Goldman Sachs? Can I say that?
Well, I don't. I think it's safe.
If it's not fair, then say it's not fair.
Well, no. So I'm going to break down because there's three pieces in which we're talking about, which is the thinking about like the government within the context of insurance markets. Then there's the broader role of government, like when does it step in, and then there's the financial crisis, which I think I'll take the third one, the third one first, which is the easiest. the federal government's response to the great financial crisis in 2008, saved the entire, U.S. economy. And for that matter, actually, let's just be blunt, the global economy, because you had a credit crisis. And there's nothing worse than a credit crisis because that destroys money. And then when money gets destroyed, economies essentially collapse. And anybody that was engaged in the activities of banking or financial services, or just interfacing with households within the context of movement of money, really benefited from the U.S. Congress's and the administration's aggressive response to that crisis at that point in time, because the outcome could have been infinitely worse than anything we experienced. On the now I'm going to cycle back to your first question, which is the thinking about should the government get much more involved to a greater degree in the insurance markets? And my answer to that would always be, before you look to particularly federal government response, I would like to study actually more, if I had some free time, or if I was involved in the insurance markets more, can you look to the capital markets actually as your first solution relative to the governments? Because the way the insurance markets operate today, they tend to be through institutions that mutualize risk, leverage reinsurance markets to manage that risk. And I've always thought that the massively deep pool of liquidity in capital markets that exists in our capital markets today, and the expertise that exists in our capital markets, why we collectively haven't done more work around looking at the capital markets as a potential source of risk-bearing capital for the natural risks that are going to be incurred across the hazard markets in the U.S., which are obviously what occurs in Florida or Louisiana is very different than what occurs in California vis-a-vis which might occur in Maine. But looking at the capital markets as a potential source of capital seems to me to be a better solution in the near term than necessarily standing up a new government program. And the good news there is, we have precedents for that. There's a well-defined cat bond market that's existed for decades now, and it's, I think, whether the insurance industry and those that have a nexus to the housing market and policymaking for the housing market can make it easier for the capital markets to provide that risk-based capital, I think would be an effective first step. And then you have to ask the question of, if that's not ineffective, is there a more aggressive role for the government to play? Yeah. Akin to what the government does for banking, insuring deposits. There's no federal, we have to have that in order to prevent runs. And there's no capital market solution to that the government can't provide by providing FDIC insurance on just regular way banking accounts, checking accounts, savings accounts up to I believe it's still $250,000 threshold.
Yeah, it is. We're going to go back to ICE here in a minute, but this is just so fascinating, the amount of directions that you're able to go in because of your deep experience in the private and public sector.
And by the way, I'm deeply passionate about these things, and
I know.
love thinking about markets and how you leverage markets to deliver solutions.
Yeah, so that's what ICE is all about. And you're really working hard on that. I am going to get back to that, I promise, but I don't want to lose my train of thought because I'm very capable of doing that. So I have this idea. I want to ask you about it. This is going to be another off the cuff, but I just want to read a little bit of your bio. You managed significant assignments, such as when you were at Treasury, such as overseeing the nation's investment in Fannie and Freddie.
Yes.
We could talk about that forever. Coordinating new rules for the securitization market, working to establish refinancing programs. This is where I'm going with this. For borrowers with little to no equity in their homes, HARP, that program, and restructuring the TARP housing program. You had your fingerprints, unbelievably, were on a lot of these things at the most sensitive part of our economy that we've ever been subject to. So where I want to go with this is so I have a question for you. I've been kicking this around in my head, but I know you've forgotten more things than I know. So I'm going to ask you, the expert. We still have, I think it's 40% of agency mortgages are below 3%.
Yep.
So is there an opportunity to do a reverse TARP program or put something together to incentivize these folks to get out of their homes? Some kind of a credit, to trade in the 3s for the 5s
Oh,
for
wow.
credit or something like that. Like, I'm
I'm
wondering.
smiling ear to ear because actually, a buddy of mine and I worked on a proposal in this regard to thinking about like how do you create some value sharing mechanism
For
with
sure, we'd
those.
incentivize them. Like maybe you can take more out of your 529. Maybe you could put more away in your 401k. Maybe you can write off more interest on the new home. Maybe the government would subsidize a down payment on a new home. Like, any thoughts on that? And totally off the cuff.
A lot. I mean, an awful lot because obviously obviously it's maybe too strong of a word. I think a lot of us have a strong hunch that house lock, the benefit of just
Yeah.
having such a low mortgage rate is, significantly impeding, housing market velocity in the United States. The best example is, the third kid shows up. Typically, that household's going to move, and they're going to move to something larger.
Yeah.
Where in the current environment, if you're sitting on a 3% mortgage rate and you've seen home prices go up by 30% since you bought that house, and so anything that you might be looking at is even more expensive, you're going to be like, oh, I'm going to stay put. And then all of a sudden, that starter home's off the market, and then you don't have the velocity of that family trading up to a larger home that might be appropriate for 3 kids. So I think this is a real economic issue. It's one I'm going to be spending a lot of time engaging with policymakers on in DC, certainly over the course of the coming weeks, months, quarters, as much time as they'll give me. And, the concept that, and I'd love to, come and present it to you at some point in time that I've had is there some type of sharing mechanism that can be done within the context of those that have invested in those either mortgage-backed securities or banks, credit unions, other entities that own mortgages with note rates between call it 3 and 4, just to use round numbers, that just on a value basis are not worth par anymore. They're they're worth less than 100 cents in the dollar because the interest rate is so low. And that homeowner that's willing to that would typically say, you know what, it's time for me to move to buy a different house or move to a different geography, but I can't. I'm not going to because if I go buy that new home, I got to pay a 7% note rate as opposed to 3% I have. Is there some way like you could split the difference and find through a capital markets mechanism where basically that home that should be home buyer that's not a home buyer because they have a 3% mortgage, if you could offer them a 5.5% mortgage for that new home that they're going to buy, if they trade out of their old 3% mortgage, then all of a sudden you're like, the system might start to work again because they're like, okay, I knew I got a benefit once in a lifetime with that 3% mortgage. I really should move. Seven's too expensive for me. But if my note rate's going to be in the 5s, okay, I'll do it. And these are one of the ideas that myself and a buddy of mine actually that the two of us work together at Treasury, and he's got a banking background. I've been going back and forth on this.
Can you keep me posted on this idea?
I definitely will. Well, when I'm down next time when we actually properly plan a visit, down in Northern Virginia, I'll come and present it to you, and you can tell me what you think.
Yeah, interesting. Because the idea also, I mean, people make the assumption they're going to have all this equity forever. We've seen people that thought they were sitting on a mound of cash. In some areas, it turned into nothing. So to be able to potentially get that equity, but still end up in a reasonable loan, I would love for you to just send me anything you have on that.
Yeah, I'll get you the write-up that I've shared with policymakers. I'd love to actually get some more attention on it in the near term.
I'd love to give it to you. I want to get back to ICE. I know we're running up on the bottom of the hour. Do you have like a hard stop, or can you give me a few more minutes?
I'll give you as much time as you want on this, Greg.
All right. Let's make sure that we cover ICE. I could just keep talking to you. So I've got some questions. So is ICE driving innovation or consolidation?
Oh, I think we're driving innovation. I'm just looking at the what's in my pipeline of how we're improving our underlying products and integrating our products that drive a better household experience while contemporaneously make it more efficient for originators and lenders and servicers. I think we're all about innovation here, and all about, like, how do you achieve that through the integration that we're doing of our core product systems, and then listening to our existing clients on, like, what are the true pain points that they need us to solve.
Yeah. All right, here's another one. Giving rising costs and origination, what specific steps is ICE taking to simplify processes, reduce costs, deliver meaningful value through a connected ecosystem against the perception that ICE is raising costs? And I would imagine, Tim, it's like a race against time. You're putting all of these resources into making these acquisitions to deliver a more streamlined process. Obviously, you're delivering more value. There's a cost associated with that, but from the outside looking in, people are like, yeah, you're adding all this, but my costs are going up. They're not going down. So how do you weigh that out on a seesaw?
Yeah, well, that's the crux of adding value, right? Because you got to invest to add value, and as you know, investing requires economic resources, it requires funding, and you better have a good, a good use case, a good clear ROI after you've made those investments. And I think we do. So I'll just for this conversation, I'll stay very focused on, like, in the origination markets. It's like, what are the costs that you can control, as an originator? And I always think about, like, a couple. Number one, like, how do you make certain that you're not going to get you're going to reduce to the greatest extent possible potential future claims for repurchase or rep and warrant risk? And that's having a much more streamlined, efficient manufacturing process with multiple times during that process. You're checking to make certain that that loan's sellable, and it's being structured in such a way that when that loan gets ultimately sold to investors, they can clearly see it was manufactured appropriately to their standards. And this is equally important, is if that investor ever wants to query you back, there's an efficient mechanism to engage with them without having to throw tons of people at it. That's just going to screw up your cost structure. Second key area is thinking about the underwriters. And underwriting is such an important skill, and it's fundamental to what we do. And it's also one in which we desperately need people to be as effective as they can in those functions. And we're not making a ton of more underwriters in the country, for better or for worse. Kids graduating from college today, or people aren't making, like, the career move and say, I want to be an underwriter. So we need to help those folks scale, and help them scale effectively at the lenders that we service that today. And that's why we're spending so much time trying to, in partnership with our lenders, trying to deliver an underwriting analyzer suite that can help them get through a loan more efficiently and appropriately, with contemporaneously reducing risk at a latter date that you have to engage with an investor that you've sold that loan to. And then thirdly, it's how do you interface with that? How do those lending officers interface with the households much more effectively, and in such a way that they're not wasting that household's time, and also that lending officer, they're not wasting their time, because in the market that we serve, it's still a people-driven market. So you're still going to have lending officers going to be engaging with households, having that valuable touch point around a mortgage, which is inevitably is going to have 6-7 digits associated with it. And I think that's why one of the things that we're trying to do at ICE is deliver a truly integrated household interface for that lending officer, or for those that engaged with households at lenders, around, like, what their CRM, around their lead management tools, and around their point of sale. So everything that they touch with the household seems a lot more coordinated and can be more efficient, which ultimately saves the lending officer time, which allows them to engage with more households.
And if there's more efficiency involved there, you'd think you'd need less bodies, which could drive the cost to produce down.
Or, as I'm hopeful for, the bodies that we have in the system can do more business when this market finally corrects itself. Because that's one of the things that I continue to hear over and over again is, Tim, you got to help us scale, because we're not going to stick in a market in which we're only making 5 million mortgages in any given year, the same amount we made in 1991 when I was in high school. We're gonna, this market's going to go back to a 7 million, 8 million, 9 million unit market over time, just because the underlying fundamentals, the economic the the economics and the demand and the fact that on a generational basis, people are going to continue to want to buy homes. We're going to have a bigger market, and we're not necessarily manufacturing more professionals in the mortgage market today. So that the existing set of professionals needs to scale into that larger market when it materializes, whenever that might be the case.
So you talk a lot about publicly an end-to-end solution
Mhm.
that delivers a better household experience,
Yes.
unified technical approach, a fundamental understanding of households having an end-to-end solution, borrowers being able to refinance much more efficiently, MSP speeds that up, seamless as possible, least amount of cost. These are all words that at one time came out of your mouth.
Yes.
So we know how you feel about that. So the question I have is two main focuses of the business. There's the
Mhm.
origination, and then there's the servicing, right? And the marriage of the two to create this seamless experience. If you're an IMB that's not servicing,
Mhm.
are the benefits as great for them as they are for the IMBs that are?
I think so. And the reason why is I think your loan is more valuable if it can migrate from your loan origination system seamlessly onto a servicer's servicing system without errors and and reduced amount of human touch points and stare and compare work. So if we can construct a file in partnership with lenders that can easily be boarded onto a servicing system of record with minimal errors, minimal human involvement, that just makes that loan much more valuable to that buyer of servicing. And that's actually a core priority of mine over the course of the coming weeks and months as we actually start to roll that out, our loan boarding functionality that will make it much more seamless to take a loan that's manufactured in Encompass and get that onto MSP with minimal human involvement. And I
Okay.
know, Greg, this is shameless, but I'm going to do it because otherwise my team's going to get mad at me. There's going to be a lot more to hear about that at Experience in the coming weeks because that's going to be
in Vegas in March, right?
yeah, that's exactly right. That's going to be something that I'm talking to that entire conference about. And
I've
then
never been, but I am planning on going. I've not asked my wife yet for permission, but I think this might be one of those
I will
situations
not
where
be part of that process, but
yeah, I'm gonna just
definitely
I'll
invite.
either beg for forgiveness or I'll have you make the call.
Yeah, and
You
maybe
know,
we can re-engage there. So we
um,
would love to host you. We'd
hey,
absolutely love to host you.
I've got some quick hitters, and then we'll let you go. Okay, so Fannie and Freddie, you were involved with them.
Mhm.
You know where I'm going with this.
Yes.
You in favor of them coming out of conservatorship? I mean, how do you feel about it overall?
I don't know the answer to that question. More
Okay,
work needs
fair.
to be done. The most important thing, though, is if they are going to exit conservatorship, how do you fundamentally not disturb, the functioning of the mortgage market in the United
How would
States?
it impact you if they came out?
I don't know, actually. I
Okay, all
really,
right,
I,
that's fair.
I really
Okay.
don't know because it depends on the nature of the exit. What's going to be their focus if they came out of conservatorship. What's the all the two very simple points that will resonate with you and your listeners. What's their expected market share coming out of conservatorship? Is it as large as it is today, or is it supposed to be smaller? Second question is the securities that they manufacture and sell. Are those going to have a government guarantee, or are they not going to be government guaranteed, or are they going to remain in this implicit zone
Yeah,
today, where they're government supported without a direct government guarantee?
got
Like
it.
these are the questions that really need to be answered before
I
I can
understand.
come in
Yeah,
and
you got
articulate.
you can't diagnose the patient without taking the blood pressure and getting the vitals. I get it.
Yeah.
So CFPB,
Mhm.
for all intents and purposes, is in the process of being tamped down. You know what's going on,
Yep.
and some people have said without it, we're gonna go right back to the financial crisis and the behaviors that perpetuated that. You were right in the middle of all that chaos and craziness as part of your tenure at Goldman Sachs during the financial crisis, and then the U.S. Treasury in helping to unwind it. What are your feelings about that? If there is no more CFPB or they're severely diminished, do you have concerns that the behaviors will come back again? Is that a concern of yours?
Well, I never say never. So that's I don't. There's no truer statement in life than that. I think it's highly unlikely, regardless of how the regulatory structure in the country evolves, that in the near term, we're going to go back to the behaviors that we saw back in 2003, 2004, 2005, and into 2006. I don't think investors, would bear, that type of activity. And remember, investors were critical to actually fund that activity prior to the great financial crisis. On, regulation, we all want good, safe, sustainable regulation in this country. Right? You want to make certain that people have confidence in their lenders, and you want to make certain that people have confidence in their servicers and their investors. So we need that. It just, you hope that within the context of like where we go over the course of the coming quarters and years, or in the regulatory community, that we can find that middle place. We can find good regulation that protects homeowners, that protects families, that protects the overall structure of the mortgage market. Because remember, the last thing you want is households to lose confidence in the mortgage market. The last thing you want is for investors to lose confidence in the mortgage market. And it's trying to land that into a good spot. That there's an ecosystem that works such that what's appropriate at the federal level happens at the federal level. What's appropriate at the state level happens at the state level. What's appropriate at the local level happens at the local level. But that those three core political entities can stay true to that North Star of like, how do you have common sense regulation that does protect the entire ecosystem? And that's what I'm hopeful for.
Last question. We're finally here. We're on the doorstep of the end here. As you look at a SWOT analysis, what is the biggest threat?
By the way, I haven't heard that in a while, so I appreciate you bringing back.
Of course, hey, we're old school people. You were talking about Leonard Skinner before we came on here, so I mean, come on.
Yes,
I knew you'd understand that. The last one, threat. What's the biggest threat to what you're trying to accomplish right now? And I don't mean I'm talking about from a competition standpoint. If you can speak to that, not necessarily you need better rates or this or that. Keeping it real.
I think as you just articulate, the market's going to take care of itself. Like the underlying fundamentals for household demand for housing will take care of itself. And as both of us have been around a long time, the market's normalizes. For me, the thing that keeps me up at night, the threat, is that we get disconnected from our client base. If my team, myself and my teammates, the parent company becomes disconnected from the underlying lenders that we're serving, the servicers that we provide our core technology and solutions for, that is where we're going to make really bad mistakes that potentially impair the franchise. And the thesis that we've had in pulling together ICE Mortgage Technology, there's numerous examples throughout business history where entities think they're infinitely smarter than their core customer base, and they do things that imperil their franchise. And that's bringing back to the conversation we had before we went live on the program. This is why I keep telling my team, you got to be on the road, you got to be with your clients, you got to be in visiting them. And we just actually had one of our clients speak at a leadership training session that we had here at the NYSE actually back in January. And he gave the best example of all, which he said, you need to be at your client's kitchen table. And that to me, said it all, which is like, how are you as a core technology provider? How are you as a core solutions provider, making certain that you're getting to that lender or that servicer's kitchen table to figure out like what's most important to them so you can deliver for them. It might not be next week or might not be next month, but deliver for them at the end of the year or next year or just on a foreseeable future. That's what's going to keep the franchise together. That's what's going to keep the franchise going.
This has been great. I appreciate you being such a good sport and letting me take you all over the map here.
Oh, I loved it, and I loved the host shouted experience. So,
all right, well,
great to have you there. Great, it'd be great to have the show there.
I'm going to take you up on that. I'll text you my wife's number to get me permission, a permission slip, please. They're not that easy to get these days.
I'll do a handwritten letter.
You know what? That apparently that hits home. So, I appreciate you doing that. Tim Bowler, President, ICE Mortgage Technology. Thank you.
I really appreciate Greg. Really appreciate your listeners engaging with us.
I'm amazed you didn't take a sip of water the entire time, by the way. You must be parched. So hopefully there's a water fountain or something, some Evian water, something around you to get you hydrated.
It's good. All good. All good.
All right. Thanks.
I
Thanks
appreciate it,
again. I'll
Greg. Thank you
see
so
you very
much.
soon. All
All
right.
right.
Take care.
Be well. Bye-bye now.
That's Tim Bowler, president of ICE Mortgage Technology. I want to thank Donna Chachevsky for pushing all the right buttons in the background. I'll tell you what I'm going to do next week. I am going to have a panel of folks on. I'm going to get 4 people, 2 that feel like the CFPB being diminished is going to lead to the next financial crisis, and 2 people that have the exact opposite view that are embracing this idea. And we're going to have a spirited debate. That's next Monday at 1 p.m. Eastern. Don't miss it. Have a great week, everybody. So long.